Hey, good morning, everyone.
Good morning, Professor.
Hey, good morning, Angelica. How are you?
Good morning.
Huh. Well, did everyone have a great Thanksgiving? I hope you did. Well, I see like how many people here? I see 8 people, but it's awfully quiet. I would assume that everyone had a great Thanksgiving, and it's time to get back. Time to get back to our normal routine. Okay, I'm sharing my sharing my application, sharing my screen. So, so we are moving on to. Oh, before we move on, uh, first, yes, we are now into topic 4, right? We're into topic 4. So you would need to download these 2 files, and by the main lecture, we're already in the last topic, right? We're in topic 7 by the main lecture. So you see, let me get back to the, okay, today's lecture, topic 7, risk and return, part 2, right? Risk and return 2. So video numbers 3 and 4, that's what. So we are, by main lecture, we are all done. We're pretty much, done with everything um, on our syllabus. And how many people are here? 10 people, right? 10 here. And also, I would like to quickly take your attention to this file. After every exam, I update the test results with the latest attendance. So let me quickly let me show. Let me quickly show. Alrighty. So this is a bit, disappointing results because, as you can see, this is the weighted average, and weighted average is the 20%. It consists of 20% of quiz 1 and quiz 2, 25 of midterm and final, and then attendance. Oops. And so far, I have, that makes like 65% of the data, 65, 20, 20, 25. Final will be another 25. That makes 90%. And the attendance and participation, that makes 10% of it. And then weighted average includes basically, every exam data, right? Every exam data. So even if some people have only one exam result, it is included. But then obviously, because it's only 20%, it's inevitably weighted average will be very low, right? Because these people are missing, right? 25% and 20%, right? And then the attendance isn't that for this person. Attendance isn't that. Uh, Attendance is very, mediocre. I mean, most likely. So when you include something like this in the data, then obviously the mean will have to be very low, right? Mean will have to be very low.
Professor, I
Uh,
have a question.
yeah.
I was wondering, what's the highest you could get for attendance and
Oh,
attendance?
there's no limit.
Oh,
Think
okay.
about it. This is not just attendance, but attendance and participation.
Oh, okay. Okay.
Remember, it's supposed to be originally, like 10 points, but 5 points from attendance and the other 5 points from participation. But participation has no bounds, no limit, no upper limit. First of all, the attendance, I've been telling you, each attendance is 0.167, right? Because then, 15 weeks, 0.167 times 15, 30 sessions. One semester is 15 weeks, therefore 30 sessions, times 30 will give 0.167 times 30 will be like 4.999, almost 5 points. And then participation, it will be, if you give me great answer, it's 1 point. Good answer, 0.5. Average answer, 0.25. So if you give me like 20 good answers, that's just 20 points, right? It's straightforward 20 points. I mean, if you give me 30 great answers, 30 points. So there's no upper bound in participation because participation and attendance is combined. If you have full attendance, 15 weeks, all 30 sessions, you get 5. And if you gave me 30 great answers, 30 points, that's going to be 35. Right? So let's say someone like this gave me, this person has, absolutely, zero attendance. Um, but, if this person gave me like, great answers, like 30 great answers, perfect attendance, it's got 35. So this is more than enough to think about it. Uh, Midterm, you got 100 in the midterm, let's say, but it's only when it's weighted, it's only 25%, so it's going to be 25. But if this person gave me, 30 great answers, that and it's not it's just raw because it's originally supposed to be 10 points, but this is 35 points. So this will not be scaled down because the weight was already, after the weight. I mean, that 10 point was, after the weight. So this 35 points will just translate. It will go into 35 points. It will go into the weighted average calculation as 35. Then it will be more than enough to offset this, right? That's the importance of, participation. So there's no upper bound in attendance and participation, right? Attendance alone, it's 5 point, right? Upper bound is 5 point, but and then think about it. Quiz two alone, right? Um, that if I sort it by quiz two alone, you see highest to the lowest, and only how many people? 41 people. That's what 41. Okay, so and then by attendance, who had the highest attendance? This person has the highest attendance and participation, right? And then although this person didn't do that well in the midterm and quiz two, weighted average, I mean, if it wasn't for the attendance, weighted average would have been much lower, right? And then, but still, this person did very well. I mean, considering that Mean of the weighted average was only about 40, right? Standard deviation was 16. So my criteria is if you're above one standard deviation uh, above the mean, right? So that would be like 46. If you're above 46, that's roughly about equivalent to A minus. That would be the cutoff line for A minus, right? If you're like 1.25, 1.5 standard deviation above mean, so this person, I hope this person will do very well in the final. Then, of course, weighted average will change, and the mean will change. When I have this data, mean of the weighted average will change. Um, but then 1.5 standard deviation above the mean would be 8 points above this will be like 24, 40 above 20, 24 above 40, 64, or 1.25 standard deviation. 1.5 standard deviation above mean will be like 20 above this, like 60. People above this, people above 60 will be um, pretty much, in uh, A range, A category. But again, this is not, this is, not fixed. This can change because if these people mess up in the final, right? Because final is 25%. Their rank in the their ranking in the weighted average after the final may go down, right? So it's not a fixed thing, right? And the mean of the weighted average will move after I get the final data in. A standard deviation will change when the weighted average changes. Okay, so and again I said after um, if you after everything all the data are in. And if you are at risk of falling below B minus, currently, if you are like, 16 points below 40, so that would be like, 24. If you're like, below 24, then that would be that would be like below B minus. It's just a rough rule of thumb. Once again, as the weighted average changes, as the new data come in, right? As the new data come in. So if you're at risk of falling below B minus, then I will look at you see what this column is, it says homework average. So I will take the average of all the chapter problems, and remember there were two practice tests in ROI, right? The average of all those will kick in. So, for example, this person missed quiz 1 and quiz 2. Hopefully, this person won't miss final. But if he or she misses also final or gets 0 in the final, I will apply the homework average to replace the final, because, well, if he has or she has all zeros here, then it only makes sense to replace the exam with the highest with more weight, right? Because final is 25%. It's better, to apply that to final because it's going to be 25%. It's better than, applying that to 20%, right? And if this person has final result, then I will apply to either one. I will apply homework average to either quiz 1 and quiz 2, or quiz 1 or quiz 2, just one. It doesn't matter which one to apply to because they are both 20%, same weight. So then the result will be, then the weighted average will be bumped up. It may not bump it up significantly, right? But at least they will bump up even marginally to pull this person out of, C plus and bump this person up to B minus category. Or, everyone below B minus will get that, uh, will get that, extra boost. That's why you must do all the, chapter problems, right? That's why you should have done all the, and for the people who are already above B minus, that won't be applied because the fact, if you got A, if you're in A or A minus, it is, and if you have done all the chapter problems, then it's thanks to the chapter problems, right? I mean, you could have, without doing the chapter problems, you would have got A minus instead of A. I mean, if you got A, having done all those chapter problems already helped. So you got the reward already. You already got the reward. You got rewarded, but from in better grade. And also, some people who are at the borderline, let's say you got A minus, but you are at the borderline, you are marginally below the cutoff line for A minus. I mean, marginally means, it is within like, uh, 0.5, within 0.5 margin, right? If the cutoff line for A minus is, 80. Cutoff line for A is 80, and you got 79.56. By rounding, you are, you can be rounded up to a, I mean, I will use rounding up. I will round it up to A. All the grades, if you're at the borderline of those grade cutoff lines, I will use the rounding up. I will round it up. Okay. So if you are above B minus, and if you're marginally below the cutoff line, it will be automatically rounded up. If you're below B minus, all of those, chapter problems, it will pay off. And of course, if you are already in good grade range, right, above B minus, then all those chapter problems have already paid off, right? So that's the idea behind it. Check your attendance. That's the attendance, attendance points, right? Total number of absence. These, someone like this, 22 absences. That's like probably, yeah, only 2 attendance, right? That's, so that's it. So, okay. Any further questions about the that result? Okay, no. All righty. So as I said, we're moving on to the bond valuation. First, how the bond price is quoted, right? And we know already about a lot about bond, right? Remember, because in the first topic was ROI, but in ROI and macroeconomy, we talked a lot about bond, right? Because the interest rate a big force in the interest rate in the long term, especially. Short-term interest rate is all, short-term interest rate is based on, Fed funds market, right? Fed funds rate, but the long-term interest rates are based on the bond market. Of course, it's Treasury, U.S. Treasury note. There's the benchmark for long-term interest rate. But based on that, all the interest rate on the bond moves in the bond market. So we know already that there are, depending on who issues the bond, right? Who is the issuer? Where's the okay, let me bring up the whiteboard. Okay, so depending on the where's the pen? We all know, depending on the who is the issuer, the bonds can be classified into Treasury, corporate, and municipal governments, right? And then depending on the maturity, right? There is short-term and long-term, but long-term gets divided into two categories for Treasury only, right? Now, so federal government, right? When federal government borrows money from the bond market, it's called the Treasury Securities, and I told you Treasury Security is a collective name, right, for the entire group, because depending on the maturity, right, the name changes to a Treasury bill, Treasury note, and Treasury bond. Right, remember that. The line between short-term and long-term is what? Anybody?
A year?
Yeah, 1 year. Yes. Who was that?
Jody and Turner.
Jody Ann. Okay, Jody Ann, you got 0.25. Yes, Jody Ann. Yes, that's the line between short-term and long-term, and the line between and actually for Treasury, three different designations: Treasury bill, Treasury note, and Treasury bond. Treasury note and Treasury bond are both long-term debts, but the line between Treasury note and the Treasury bond is what?
10 years.
Anyone? 10 years, yes. Who was that?
Jody and Turner.
Okay, Jody Ann, so you got another 0.25. Okay. Yeah, and there is no distinction. I mean, 10 for corporate bond. There's no line. There's no 10-year timeline. Everything is called corporate bond, and maximum timeline for Treasury bond is
30 years.
30 years. Was it Jody Ann again?
Yes.
Okay, Jody Ann, so you got another. Yeah, normally they just 30 years is the maximum. Okay, but under special circumstances, during the war, during the times of war, they had really long war bonds, long maturity war bonds, especially in the 19th century during the Napoleonic War. French government, Napoleon's government, issued like 100-year war bonds. But in current contemporary world, there's no like 100-year bonds. And the name long-term bond, name of the bond is the name basically reserved for long-term debt instruments. For corporate short-term bond, there is a name. Name is different. What is the short-term corporate bond called? What's the short-term corporate bond called? Anyone?
Is it commercial paper or promissory note?
Yeah. Yes. It's called commercial. Oh, the color changed. Yes, it's called commercial paper. Or it's called also promissory note. Yes, but then you might wonder, why promissory note? I mean, we already know promissory note. We learned about promissory note from the balance sheet. So how does the promissory note come into play here? Isn't promissory note a means, a method of payment, right? Yes, it's a method of payment. It's an IOU. But think about it. Since it is an IOU, it can be used as a payment, but also it can be sold in the money market. It can be sold in the money market. In other words, you don't have to buy anything. A company don't have to buy anything and use promissory note as payment. But rather, without buying anything, they can just sell promissory note in the money market as a means of short-term financing, short-term borrowing, right? Now, in that case, it is called commercial paper. In that case, it's called commercial paper. And promissory note is used in the context of B2B, business to business transactions. Okay. So commercial paper, because commercial paper is promissory note, and promissory note carries interest. It pays interest, right? This can be sold as short-term bond in the money market, right? It pays interest for that, Now, for municipal bond, municipal bonds don't have any short term. Generally, they don't have any short term. They all have very long term, right? For municipal bonds, they have, long term in general. Most of the municipal bonds are like 30-year. They have 30-year, maturity, or even 50-year maturity. But 30 years most of the time. So with that in mind, right? With that in mind, let's take a look at so first they are showing you Treasury, and then corporate bond and municipal bond. Okay. And in the second column, you will see coupon rate. Coupon rate is the interest rate that the bond pays. This is, a company named the CIT Group. I believe this is an insurance business. And they were paying 7% coupon rate. Maturity was May 2016. So it was already, you can tell, this example was from way back. Yes, actually, this example was taken in 2010. And how do I know? I traced it back because you know how to calculate N, right? You know how to solve for N. When you can calculate N, you can, trace it back. And I traced it back to sometime around June, maybe not June, May or June of 2010. So as of that time, of course, they still had, like 6 years left, right, to maturity. That's the second column, coupon rate, maturity, the third column. Municipal bond, coupon rate of 4.5, maturity June 15th, 2037. So most likely this bond was issued in 2007. And the example was taken in 2010. As of that time, as of 2010, it still had like 27 years left. Now, unlike corporate bond and muni bond, right? Treasury, second column of the Treasury is not coupon rate, but they gave coupon rate in the first column, 2.75. So the lowest coupon rate, of course, we all know U.S. federal government, U.S. government is the safest borrower. In other words, riskless. So it's a riskless. It's a riskless borrower, so they don't have to pay high interest rate. And among these three, corporate bond has the highest coupon rate. Of course, this is look at the agency who issued this municipal bond. NYC Municipal Water Finance Authority. It's New York City government. And when New York City, think about it. What are the chances of New York City government going bankrupt? New York City government, if they're all the municipal governments go bankrupt, right, in the world, right, all the municipal governments go bankrupt in the world, state government and city governments, all including, New York City government will be the last one to go down, right? I guess before New York City government, the London city government would go before that, and then before that probably Tokyo. I don't know. I can't say exactly if Tokyo will be the one before that, or Shanghai. Okay. And then before that, it would be probably Frankfurt city government would go down before that, and probably before that Paris would go down before that. So what does that mean? These are financial centers of the world, financial centers, right? And the city government, New York City government will, but still, New York City government pay, 4.5% coupon rate, which is almost, not twice, but almost twice, below, slightly less than twice. In the CIT group, I haven't, when I, back in 2010, I don't know what's their credit rating these days, but back in 2010, they were pretty much, I believe they were in like triple B category, triple B. And this was, in 2010, this must have been, the average coupon rate for the bonds that belong to triple B category. Now, in the second column for Treasury, you see maturity, right? Month, year. Whereas, maturity was in the third column for other types of bond. It says February 2013. So it's already over. It was like, 8 years ago. But, since the example was taken in 2010, considering that, they still had like, more than 2 years left. And then what is that N next to 13? That N means this bond was originally issued as Treasury note. That means it was originally a note. It is still a note because it has no more than 2 years left. But once time passes and once the bond has less than 1 year left, it is treated as Treasury bill. Okay, so the bonds may be born as Treasury bond or Treasury note with 30 years, with 30 years to maturity, it is born as Treasury bond. But as time passes and 20 years have passed, and the bond has only less than 10 years left, then it is treated as Treasury note. Okay, and then time passes and 10 years have passed, 9 years have passed, and it has only less than 1 year left, then it is treated as Treasury bill. Okay, so that's how it is. And next, let's take a look at fourth column. Fourth column, corporate bond. Last price, 91.735. Does this seem a little out of place, don't you think? Why? Price was only like $92. Isn't it? Why? Because, at maturity, what do you get? Right? If you are a bondholder, at maturity, what do you get? What do you get paid at maturity? What is the maturity value of the bond? Anyone? Anyone? What's the maturity value of the bond? How many people are here? Let me see. I have 11 people. 11 people, but I don't see any.
Professor, can you ask the question again, please?
Yeah, the question is, where was I? The last price, look at the fourth column. The fourth column, corporate bond, last price was 91.735. So that seems a little weird. Why? Because what do you get paid at maturity? If you're the bondholder, what is the maturity value of the bond?
$1,000.
$1,000, yes. And who was that?
Jody Ann.
Okay, Jody Ann. So you got another 0.25. Okay, you got another 0.2. Yes, $1,000. In other words, that's called maturity value, face value, par value, redemption value. It goes by different other names, but they all mean one thing. At maturity, you get 1,000. Okay, that's what. No matter how much you paid for it, no matter what you pay for it, at maturity, you get $1,000. Okay? And then until then, if this was a 10-year bond, 10 years, coupon rate is 7%, so that means you get $70 a year, $70 every year. So for 10 years, it's $700, right? Of course, in reality, you don't get paid interest once a year. You get paid you get the interest twice a year. So each time $35, right? $35, but annually $70. So think about it. That means I told you these examples were taken in 2010. So that means this bond still has 6 years left. 6 years left means $70 interest, $70 coupons for the next 6 years, right? Every year, right? So that alone is $420. That alone isn't that right? 7 times 6, right? That alone is $480. 400. What is that? 7
7
times.
times 6 is 42.
Yeah, 42. Yes,
Yeah.
$420. Um, that alone is for the interest alone is $420, right? And then think about it. Even, we need to find the present value of that, right? So even the present value won't be as low as $100, right? You just discounted, of course. And think about it. This is annuity, right? It's the present value of annuity. Um, Still, it won't be that alone. Present value of that alone will be more than $100. And then, but the face value, maturity value of 1,000, you discounted to 6 years back. The present value of that alone would be, cannot, that alone would be more than, at least something like, two, $300. How can the price be $91 only? So something's, way off here. Something's not right here. Okay. So what does this mean? Actually, what this means is the percentage. All the bond prices are quoted as percentage of the face value. So this is 91.735% of $1,000 face value. Make sense? Then it's clear. It cannot be $91. It's $917.35. Make sense? The prices are quoted as percentage. And this is how it shows in the print media, And in online media, it's pretty much the same, but it varies. Sometimes they give you the actual dollar price, that percentage price. But based on the print media, it's like this. And then municipal bonds. Now we understand. Oh, the municipal bonds. So this means 97.57%. 97.57%. Yes, but then does that mean $975? No. Why? Because the face value of the municipal bonds are not $1,000. The face value of the municipal bond is $5,000, right? So municipal bond has $5,000 face value. That means, of course, obviously, right? That means if you multiply 5,000 by 0.9757, then you will get the municipal bond price. That will be 4,000 something, 4,600, right? So it's not difficult. But then something that makes you scratch your head is bid and ask in Treasury. Now, why? First of all, what is bid and what is ask? If you have ever bought something on eBay, right, or sold something on eBay, you would know the difference in bid and ask. Bid is the price that in auction, bid is the price that the buyer is willing to pay, right? Ask is the price that the sellers are willing to accept. So there will be a difference between bid and ask. So, okay, but why didn't they just, for Treasury only, why do they show bid and ask separate bid and ask price? Of course, in Treasury, the actual transaction is closed. Actual transaction is conducted by the dealers. Dealers will fill the gap. And dealers make money, from they are mediating, between bid and ask gap, right? Mediating between the two. They are. And next thing is still something that makes you scratch your head. Okay, so the prices are basically a percentage of the par value. then this means 104%, 104.25. I mean, why, if it is decimal, I mean, if it is percentage, that must be the decimal point. But why is it colon there, not decimal? Why is it colon? The colon here is not the it's not decimal point, but it's it's 25 over 32, and this means 26 over 32 of 1%. So it's like 104% and 25 over 32%. So 30-second system. Treasury uses 30-second system. That's quite that's kind of, why do they make it so complicated? Well, actually, in the old days, it wasn't that was not a complicated system in the old days. Let me give you, how this is calculated. It's not a difficult thing. So numbers after colon represent 30 seconds of 1%. So a bit of 104 colon 25 is $1,000 times 104% and 25 over 32 of 1%, right? So if you do this, you come to 1,047.81, and then ask price will be translated into 1,048.13. Okay, and of course the buyer will have to pay this price, right? Buyer will have to pay this price, otherwise and the dealer will actually make the difference. The dealer will dealer gets this and will pay something less to the seller, right? Dealer gets some percentage, right? So anyway, the point is, oops, this is like online. I'm looking at this online, so it gets it moves quickly. So that makes sense, how we can, translate this into dollar price. We can do that. Next thing is, why did they do that? So here's the thing. I don't know if it was here or maybe not this one. Okay, not this one. So I'm gonna delete this. Maybe it was this one. Yeah. So think about it. If you have a car, or if you rent a car, you will see, if you look at the fuel gauge first, it is you will see the fuel gauge, divided into 4 sections, right? 4 segments by quarters, right? This is full and 3/4, half, the bottom quarter, and then empty, right? Although it's showing only like that, but you can visually, you can make, you can split it into 2 again. then it's going to be what? 1/8, right? Each notch is 1/8. Split it again, 1/16. Split it again, 1/32. So why do they use this system? Um, since the 20th century, there's no need for this. But in the old days, think about it. Even the 17th century, there was a stock market. 16th century, there was a stock market, right? 18th century, there was stock. At least in 16th, 17th century, 16 something, 1600 something, 17th century, and famous, the tulip frenzy, tulip boom. Took place in Amsterdam in the 17th century. In those days, they speculated on tulip bulbs. Tulip was a big export, big item in those days, and tulip was exported to a lot of countries, and Amsterdam stock market, right? They were, and during the mercantile era, the era of great discovery and great ocean going vessels, I mean, this mercantile is called mercantile era. During these times, a lot of trades, right? International trade, overseas trades happened, and a lot of people. There was East India Company um, established by Netherlands, and Dutch East Indies Company, and in England, there was also East India Company, right? They are basically doing the spice trade with spice, and silk and things. So for those were big businesses in those days. Those trade, international trade, but in those days, all ocean going vessels. Christopher Columbus, basically came out trying to discover the path to India, ocean path, maritime path to India, by going west, not by going east, right? It's the age of discovery, and followed by the age of great maritime trade in those days. So they oops, I didn't do anything. Why is it? So in those days, there was stock market, even in 17th century and 18th century. And then, and this people, of course, those who are investing in the stock market were relatively wealthy aristocrats, and they lived in the countryside because they owned their manors, right? Because they inherited those large estate, through the feudal system, in the Middle Ages. And they have large land, and their economy is based on the land. It's called the physiocracy, economy based on land. Also, agrarian economy based on land. And with the money, wealth they accumulated from the agrarian economy, they invested in the stock market, right? But the news from the financial center, usually the capital of the country, the news from especially the stock market news traveled very slowly, because in those days, newspapers were rare. I mean, there were you understand, Benjamin Franklin in 18th century, uh, printed, newspaper, but the newspaper was circulated because of the geographic limitation and the transportation limitation in transportation. It wasn't circulated, nationwide. It was just, local newspaper, right? It's, it's got a limitations to its ability to distribute. And if the newspaper travels to a remote area, it has to be carried by the messenger on a horseback, horse riding messenger. Think about it. It takes days and days to the remote countryside. So when the newspaper gets there, it's not no longer the news, right? It will be, and so you cannot wait for the newspaper. You just have to these stock market uh, data, stock market stock quotes, news must travel by the messenger on the horseback, and they just have to jot it down, scribble down on a piece of paper quickly, and then the prices in those days, trading wasn't, that frequent, right? So the prices had, some range of, the margin, uh, so when the messenger leaves, the price would have, and when the messenger arrives to the countryside, um, the price would not still remain at the same level. It goes without saying. It will have some margin. So there's you need to have like a uh, precision, like $917.35. It's just they simply quoted it in like this fuel gauge, by quarters and by the eighth. And then, the most precision they could go to was like, 32nd. Okay. So that was, that's why they still use, that 30-second system. Okay. So that explains, that gives you a lot of background about the institutional aspect of the bond. Okay. So let me, it's 12:01 currently. I just checked the time, 12:01, and I think it is a good time to it's a good time to take a break. Uh, so let's take a 10-minute break and let's reconvene at 12:12. Okay, reconvene at 12:12 and 10-minute break. All right, we're back. We're back. Now, so, oops. We already know now how the Treasury is quoted, right? And then Treasury price of the Treasury, right? We want to know how municipal bonds, right? And I already said municipal bonds have face value of $5,000, right? Uh, so finding, the municipal bond price is not a difficult thing. But one thing, one great aspect of Treasury bond is that it is tax exempt, right? It's tax exempt. In other words,
Of Treasury or municipal?
municipal, I'm sorry, did I say Treasury?
Yeah.
Municipal bond, right? Municipal. Um, so it's a big advantage. And also the disadvantage of Treasury, I'm sorry, the municipal bond is it's $5,000 price, right? $5,000 face value. Now that means it's still selling at very high price. It would be like it would still be selling for like 4,000 somewhere around 4,000, right? And so that's why individuals, generally individual investors are not generally investing in the municipal bond, but it's mostly the institutional investors that invest in treasury bond. I mean municipal bond. I just keep saying treasury. So institutional investors like insurance companies, right? They have huge cash flow. Think about it. Insurance companies have only cash inflow, mostly cash inflow rather than cash outflow, right? Insurance companies generally don't pay out. Of course, there are constant. There's health insurance, right? Medical. There is auto insurance, home insurance. Fire. Flood. Disaster, natural disaster. But the thing is, the point is, there will be no insurance business if the payout is greater than pay in, right? Makes sense? If the obviously they have more cash inflow than cash outflow, and they use these funds, right, to invest in the stock market and bond market. But because they have insurance companies have long-term, for example, if it is pension fund, some insurance companies are also handling pension fund, as a financial institution, they would. And then if the payout is going to be for a long term, right? I mean, they have to have safe, secure, long term investment that can pay out to like pension fund, right? When retirees, when people retire, let's say at the age of 65. I mean, retiring at the age of 65 is too early these days, but a lot of people in their late 50s took early retirement during the pandemic. They have, and if they have, they say 4.4 million quit jobs during the pandemic. Not quit jobs. That means they have and most of these people are retirees, who took early retirement, and it's because they have, a good their retirement account, uh, swelled. They benefited from the good stock market during the pandemic, so they decided to retire early. But usually 65 is too early to retire these days because average life expectancy has gone up. I myself don't want to retire until I'm like at least 75. But I don't know. My mind will change before by then. But if my health allows, why not? But the idea is, suppose people retire at 65 and still, have like still 30 years left, 30 years, like people live to 95. I mean, that they may not. The average life expectancy is, at best, like 85, for women, 82 for men. But at least, if you retire at 65 and, for the remaining 30 years, if you have good, income, like from pension, right? Um, the thing is then for the pension funds, they should be able to pay out, like $3,000 every month for the next 30 years, something like that, right? Which is future value of annuity. And the insurance companies must provide this. So then all this money coming in, cash inflows, they will have to put into a safe, sustaining, right, investment instrument, like U.S. Treasury or municipal bonds. Make sense? Municipal bonds, which has 30-year, and municipal bonds have better coupon rate than it pays better interest than a Treasury. So most of the times, muni bonds are held by the large institutional investors, right? And they do that also because of that benefit of tax exemption. Okay. Now, so think about it. It's basically preventing double taxation, because you don't pay once you pay on state level, you don't pay on state level. Once you pay on state level, you don't pay on federal level, right? So it's tax exempt on federal level, at least on federal level, or in the state where the bonds were issued. And then the question is, remember, although the coupon rate is 4.5, actual return will be greater than 4.5. And actually, that's the difference between yield and the coupon interest rate. Remember, so the fifth column here is yield, and here, in case muni bond and Treasury, yield is in the sixth column. What's yield? And remember, yield is different from just the interest rate, because interest is only considering only the coupon interest that you receive during the life of the bond, but the yield is the return, right? Annualized return. An annualized return includes basically the capital gains or capital loss, right? You all remember the house value example? Do you remember house value example? Let me open that again. house value example, because so you remember this, right? In the house value example, we had two scenarios. Scenario one, where you use this house as your residence only, residence basically. And then scenario two, you rent it out. Now think about it. In scenario one, there is only one source of cash flow. One source of cash flow. What is that? Capital gains. Isn't that right? You bought this house at the end of 2005 and sold it at the end of 2016. And during this time, the house value increased by $350,000, which is called capital gains, right? During this 11-year period. And year by year, annually, the capital gains or capital loss was like this. So that's the only source of capital gain, right? Only source of capital gain. And then so when you annualize it, right? The holding period return, right? In this case, the holding period return is 233% because it's the capital gains, right? That's sum of all the cash flow, right? Capital gains divided by initial investment, right? But then if you annualize it, we use, geometric average. We'll have to use geometric average. And therefore, we get, this is arithmetic average. So if we use geometric average, but that's scenario two. This is not the, oh yeah, this is scenario one anyway. This is scenario. Geometric average, by using geometric average, if we annualize it, it is 11.57. By arithmetic average, 12.21. And I told you that's why we don't use arithmetic average, because it's overstating the actual overstating the annualized return, because it doesn't consider the compounding effect. Now, the point is, this column was basically giving you annual growth rate year by year, right? Year by year, right? But then this is what? This year by year growth rate. And if you take the average, arithmetic average, it is this, but that's wrong. You have to use geometric average. But this is basically the result of year by year capital gains. Year by year capital gains, right? But that's called growth rate because it's also return in scenario one. But it cannot be returned in scenario two because this is only capital gains. Because in scenario two, you have additional source of income, additional source of cash flow, which is rental income. And these were the annual rental incomes. And in that case, annual returns are, of course, capital gains plus income, additional income divided by B3, which is the original initial price or initial investment in one period, right? Overall, we all know in scenario two, right? holding period return is like this because think about it. It's the capital gains plus sum of all those rents, right? Rental income divided by price at time zero, initial investment, right? That gives you, this holding period return. But if you take the geometric average, it comes to 16.34. So the difference between column E and column F, difference between the two, they are both returns, but the difference between the two is that in column E, there was no rental income, right? But in this case, there was rental income. So this is the yield, right, in scenario 2, or the annualized return in scenario 2. And this is the annualized return in scenario 1, as well as the yield in scenario 1, because annualized return means yield. And in scenario 1, that's the only, cash flow. Capital gains is the only cash flow. Capital gain is the only cash flow. So that's the return. But if you look at this from scenario 2, this is only the growth rate. This is only the growth rate, right? From scenario 2's perspective, right? But think about it. The bond is like scenario 2. Isn't that right? The bond is like scenario 2. Why? Because every year you have interest, coupon interest. You get coupon interest, right? And then there's capital gain or capital loss. So bond is exactly like scenario 2. Stock is like scenario 2 as well. Now to think about it. Now then, these income, if they are constant, then it's exactly the bond. It's exactly like the bond, right? Because bond pays constant interest. Bond pays the same amount of interest every year, right? Because it's interest, right? So if this rent is constant every year, then it's exactly like the bond. However, if the rent is, fluctuating every year, fluctuating or uneven every year, then it's like stock, right? Because dividends depends on the EAT, right? Net profit. Dividends depend on EAT, and as it depends on EAT, EAT, net profit, changes every year, right? So the dividend will change every year, and sometimes dividends can even be skipped. So that's like, so if in this scenario, right, if the rent is uneven and fluctuating all the time, then that's exactly like stock. But then again, so the point is, yield. Now you see what these yields mean. Yields are, obviously yield will be different most of the times, greater than just the coupon interest rate, because there will be if huge, there will be capital gains or capital loss, and mostly because of the capital gains, it will be greater than just the interest rate. As annualized returns, they are supposed to be greater than coupon rates. And look at look at the yield. I mean, and in this case, this is lower than the coupon rate. Why? Because in this case, there will be capital loss. There will be capital loss. Currently it is 1,040 something, and at maturity it will be 1,000 only. So there will be capital loss over the life of the bond. In this case, there's capital gains over the life of the bond, also capital gains over the life of the bond. There will be a significant capital gain. So the question is then, think about it. I said, muni bonds have the advantage of tax exemption, right? Then you cannot compare uh, the yield of the muni bonds. You cannot compare the yield of the muni bonds directly with the yield of the corporate bond, right? Because you have to understand this is after adjusting for tax, this yield will be greater. So here's an example. Investors compare after-tax interest income earned on taxable bonds against return on muni bonds. Yes. Think about it. Although the coupon rate in this case is 7%, right? You might say, oh, this is much better than this because 7% and this is 4.5%. No, you cannot make direct comparison like that, because after adjusting for tax, right, this will be lower, right? So here's how you make that adjustment, which is not a very difficult thing. Investor in 35% marginal income tax bracket has $100,000 to invest in either corporate or muni bonds. Now, 35% marginal income tax bracket means this person's currently this person's top tax bracket is 35. Or it could be 32%. But what it means is, if he makes one more dollar, if this person makes one more dollar, this one more dollar will be taxed at 35%. So that means he can be currently at 32% top tax rate, and if he makes one more dollar, then it will take him to the next tax bracket of 35%. But it will be only this $1 that will fall into that tax bracket. Okay, we talked about this earlier in the semester because chapter 2 was a lot about taxes. So if he is currently at 32% top tax rate, one more dollar he makes will fall into the next tax bracket of 35. If he is currently at 35% top tax bracket and still makes one more dollar, he will still fall into 35% because the next bracket will still be too far away. Next tax bracket will still be too far away. So even if he makes one more dollar, it will still fall into 35% tax bracket. Marginal means if you make one increment, small increment. Marginal means if you make small increment, right? So one additional dollar, one increment, a $1 increment in your income, one additional dollar, what tax bracket will it fall into? Right? That is what is meant, marginal tax bracket. So if he puts this $100,000 in corporate bonds, he will get $7,000 annually from corporate bond because it pays 7%, but it will be subject to tax. If he puts it into muni bonds, it will be $5,000 every year, and there's no tax. It will be straightforward 5,000. So if we make adjustment to the corporate bond income after tax, then it's 1 minus 0.35, which is tax rate. That will be the tax. So 1 minus this will be what is left, right? What is left of 7,000? And it's going to be 4,550, which is less than the muni bond, income from muni bond, which is 5,000 tax-free. Okay, so you can compare it this way. Also, you can compare it the other way. What that means is, let's take a look at this. Oh, this. So think about it. Where's my pen? Okay. I have to use this. So, this thing is. This is my finger, that's index finger. After tax interest income, interest income of the corporate bond, right? So it's really a mouthful to use words. This is really right. After tax interest income from corporate bond. Now, how cumbersome this is, but I would rather do it just like this. If one 1 minus tax rate times interest on the corporate bond. How succinct and how, this is the beauty of math, how succinct and how convenient, concise and compact and convenient. Look at this long verbiage, but it's just condensed into this simple expression. 1 minus tax rate, that's corporate tax rate. Tau is Greek character. The Greek character tau is, T, so tax rate, times interest on corporate interest, right? Corporate bond interest. Then it will be equivalent to interest on muni, right? Because that will be after tax. So then, suppose if I'm solving for this, suppose this is the unknown. If I'm solving for this, what would I do? Well, then is x times y equals z, so it will be z divided by x, then we'll get y. So then it will be corporate bond interest is then, interest on muni bond over 1 minus corporate tax rate, right? That's what this is saying. Right? So it is yield in this case. So it will be, this one will be the dollar value. This will give you the dollar value. But if it is corporate interest rate, coupon rate, let's say it is yield, but if you want to know the rate, right? So it is more like it is yield, and once again, yield is different from interest rate, coupon interest rate, but basically the math is the same. If you want to find what is the corporate bond yield that is equivalent to the muni yield, then you just make this adjustment, right? So in other words, it's just like z equals x times y, where we have x times y equals z. All right, it looks like that's all the time we have. Any questions so far? Any questions? Any questions?
No.
All righty. So, all right. So we'll call it a day here, and I will see you guys on Thursday. Okay.
Bye,
All righty. Have a
Professor.
great afternoon, everyone. All right.
Have a great
See
afternoon.
you. All right. See you on Thursday. All righty. Stop sharing, and I will stop recording and sign out.